Imagine standing in the eye of a storm, a financial crisis that shakes markets, upends economies, and tests the resolve of even the most seasoned investors. Yet, history has shown us that every crisis carries lessons, every downturn holds opportunities, and every recovery marks the beginning of new possibilities. Today, we'll explore the critical lessons from financial crises, strategies for navigating turbulent times, and how to position yourself for recovery and growth. Let's uncover how to turn adversity into advantage in the ever-changing world of investing. Throughout history, financial crises have revealed both the power and vulnerability of markets. From the speculative frenzy of the 17th century tulip mania to the devastating 2008 global financial crisis, each episode has etched valuable lessons into the collective consciousness of investors. The first lesson is the danger of speculative bubbles. Tulip mania, where the price of a single tulip bulb rivaled that of a luxury home, illustrates the risks of irrational exuberance. Similarly, the 2008 crisis, driven by an overheated housing market and complex financial instruments, showed how unchecked speculation can trigger systemic collapse. These events remind us of the importance of discerning intrinsic value and resisting the temptation to follow market hype. Another critical lesson is the value of regulatory oversight. The 1929 Wall Street crash and the Great Depression that followed underscored the fragility of investor confidence and the need for robust financial systems. Regulation serves as a safeguard, promoting transparency and accountability, while stabilizing markets during times of uncertainty. Lastly, financial crises highlight the enduring importance of diversification. Spreading investments across sectors, geographies, and asset classes mitigates the impact of any single downturn, ensuring a more resilient portfolio. Diversification acts as a financial safety net, helping investors weather the inevitable storms. Recognizing the early warning signs of economic trouble or inflated markets is essential for proactive investing. Economic downturns are often preceded by indicators such as declining consumer confidence, rising unemployment rates, and inverted yield curves, where long-term debt instruments yield less than short-term ones. These signals point to waning economic health and require careful portfolio adjustments. Market bubbles, on the other hand, are marked by soaring asset prices, far exceeding intrinsic values. When speculation drives prices, fueled by excessive leverage and a disregard for risk, the stage is set for a sharp correction. The exuberance that precedes a bubble's burst serves as a reminder that unchecked optimism can lead to significant losses. Investors must remain vigilant, informed, and ready to adjust their strategies. Monitoring economic indicators, seeking diverse perspectives, and consulting financial experts can provide clarity in navigating uncertain waters. When a financial crisis strikes, it's easy to feel overwhelmed. However, crises also present unique opportunities for disciplined investors. Here are some strategies to navigate turbulent times. Diversification. A diversified portfolio reduces risk by spreading investments across multiple asset classes. For example, while stocks may decline during a crisis, bonds or commodities might remain stable or even appreciate. This balance ensures that losses in one area don't derail your overall strategy. Focus on high-quality investments. Companies with strong fundamentals, such as healthy balance sheets and reliable revenue streams, are more likely to weather economic downturns. Investing in quality assets provides stability during volatile periods. Long-term perspective. Crises are temporary, even if their impacts are profound. Maintaining a long-term view helps investors look beyond short-term volatility and focus on the eventual recovery. Dollar cost averaging. Regularly investing a fixed amount, regardless of market conditions, allows investors to take advantage of lower prices during downturns. This disciplined approach reduces the risk of making poorly timed investments. Maintain liquidity. Having accessible funds during a crisis ensures you can cover immediate needs or seize investment opportunities without liquidating long-term assets at a loss. These strategies, rooted in patience and preparation, help investors not only survive crises, but emerge stronger. The aftermath of a crisis presents a unique landscape filled with challenges and opportunities. As economies stabilize, Certain sectors, such as technology, healthcare, or infrastructure, often lead the recovery. Recognizing these trends can position investors to capitalize on growth. Infrastructure projects, often spurred by government initiatives to stimulate recovery, create investment opportunities in construction, materials, and technology. Similarly, sectors that adapt to new consumer behaviors, such as digital transformation or renewable energy, often thrive in post-crisis environments. Diversification remains crucial during recovery, as the pace of rebound varies across sectors and regions. By maintaining a balanced portfolio, investors can capture the upside while mitigating ongoing risks. Liquidity and emergency funds are the unsung heroes of financial resilience. Liquidity refers to the ability to quickly access cash without significant loss, while emergency funds act as a financial buffer during times of crisis. An emergency fund covering 3 to 6 months of living expenses provides peace of mind, ensuring that unexpected events, like job loss or medical emergencies, don't force the liquidation of long-term investments. Liquidity also allows investors to respond to opportunities or challenges with agility, ensuring they remain adaptable in a changing landscape. Building and maintaining liquidity requires consistent saving and disciplined financial planning. It's an essential component of a robust financial strategy, offering stability in both calm and turbulent times. Economic recoveries bring both opportunities and risks, requiring investors to recalibrate their strategies. During recovery, focus on sectors positioned for growth, such as technology, renewable energy, and healthcare. These areas often benefit from innovation and increased demand, making them attractive for long-term investment. At the same time, maintaining a defensive allocation, such as high-quality bonds or dividend-paying stocks, provides stability against potential volatility. Regular portfolio reviews ensure alignment with emerging trends and market conditions, enabling investors to adapt as the recovery unfolds. Recovery is also an opportunity to adopt a longer-term perspective, focusing on broader trends like sustainability or demographic shifts. These megatrends shape the future of markets, offering fertile ground for growth-oriented investments. Financial crises test our resolve, but they also teach us invaluable lessons about resilience, discipline, and opportunity. By understanding the dynamics of crises, recognizing warning signs, and adopting strategic approaches, investors can navigate turbulent times with confidence. The recovery phases that follow are moments of rebirth, offering opportunities for those who remain patient and prepared. By diversifying portfolios, maintaining liquidity, and focusing on long-term growth, investors can emerge stronger, ready to seize the promise of new horizons. Financial crises remind us that while storms are inevitable, they also pave the way for brighter days ahead. With insight, preparation, and resolve, every investor can chart a course to stability and success.